Prabhat Awasthi, Head of Equities and Managing Director with Nomura Security joins us. Prabhat, good morning. Great to have you back on DT. Now, Prabhat, for the moment, it's a rising tide. There is an election wave which seems to be taking everything up. What is your sense? Should one participate into this wave, or it's time to exercise caution, because historically markets always run up before elections. However, they always go down after elections.
I think Nikunj, I think there is some time to elections. You know, the results will only be known by May 16th, I think. So we are sitting in March, and if there's a strong rally before that, it'll be, you probably will be left out. So what we are recommending is that for the time being, be constructive in the markets, and very close to elections, depending on how the market has behaved, then we could sort of look at a reshuffle of portfolio. But for the time being, we are of the view that there will be, a positive momentum in the market.
Prabhat, of late one has seen that, the big boys and the big performers all of, last 6 months, the likes of IT and pharma, their strength has somewhat gotten challenged, and it seems to be a bit of a tilt coming in towards cyclicals. Which camp are you on? Do you stay put within the IT and the pharma, the exporter space, and also dabble with cyclicals? Or, is it just pure defensive play that you believe in?
No, actually, we have essentially been recommending, a bit of both. So in the defensive pack, the sector we have been underweight on is consumers for a while now, almost a year. But the IT and pharma continue to be, our overweight sectors. Along with that, we essentially have, a large overweight on banking, some of the reform plays such as oil and gas, etc. So what we're essentially saying is that by available growth, we are not really concerned about growth in IT and pharma, even though I think there have been a couple of data points which have spooked the markets. But overall, we sort of think that U.S. economy is doing well. There is some recovery in Europe, so IT will do well. So there will be always some correction in these stocks, because they, as you said rightly, they have been the strongest performers, and there will be some sector relation. But over a period of 1 year, we think these are still good stocks to hold. So yeah, we are essentially saying an approach which looks at exporters plus some of the domestic cyclicals.
Prabhat, as the house, why do you feel that banks is the best player in elections? PSU banks may look cheap, but balance sheets is dented. Private banks are growing, but they are already expensive. State Bank, ICICI Bank is at 1200, and HDFC Bank is not far away from a record high.
So there are two things, Nikunj. One is that, private banks, are they really expensive compared to the history in terms of price to book? Because the book has been growing. So looking at only the stock price might not be the right way to look at them. The fact is that these stocks are still cheap compared to history in terms of price to book. At peak, for example, ICICI Bank would have been close to 2.3, 2.5 price to book. It is probably, closer to, at about maybe 40-50% discount to that valuation. So the fact is that in terms of pure stock price, it's misleading. So we think that macro environment has improved, obviously, and banks being the largest sector, any hope of a recovery either on elections or because of macro easing in general will first reflect on banks. So that's why we are positive on banks. Balance sheet are stressed, but I think that's a story well known. Some of the balance sheet issues are largely related to policy, as for example, power sector issues, SEB restructuring, etc. But more policy environment-led issues rather than, related to or cyclical issues with growth. So the fact is that if you start getting positive in growth, then it will be less negative on NPAs going forward. Thirdly, the trend of NPAs actually has improved somewhat. If you look at the delinquency ratios, there has been some improvement from the peak that we saw a couple of quarters back. So all told, we think that valuations in terms of price to book, multiples, along with the macro environment, along with sort of election bias that people have in terms of how the economy will pan out, will essentially be a positive environment for banks.
Now, Prabhat, you just talked about, the banking play. A lot of people now are staying away from banks, but yes, NBFCs as well as, a couple of microfinance companies are the ones which are finding favor with a lot of market participants. What's your view when it comes to these two spaces?
Well, we don't cover We don't cover microfinance companies,
Sure.
so I would refrain to comment on that. But NBFC, I think selectively, valuations are not too bad now because these some of these names, especially like Shriram Transport, etc., have been essentially down because there has been a negative sentiment attached to the industries they operate in. So I think, but I'm not sure whether people have been staying away from banks. You've seen private banks doing extremely well, and there has been some life of late in PSU banks. So I think if you look from a perspective of being able to buy the India story on a, in some measure, then you have to buy, private and public sector banks. You really can't really buy a whole lot of NBFCs. But the financial space in general tends to move in line with the economy. If the economy does well, then all these stocks will tend to do well. In the first phase, obviously, the undervaluation is you can sort of catch up to undervaluations if economic conditions start to improve. So you could argue that if economy does well, in the first phase, it probably be some catch up by stocks which have not performed so far, and private banks have to some extent. So there could be a catch up by PSU banks or NBFCs, quite possible.
So with the assumption, Prabhat, that the economy may turn around, green shoots of which are already visible, would you bet at all when it comes to capital goods and infrastructure names? Because of late, that sector as well has been moving a fair bit.
So I'm not sure whether green shoots are yet visible. I think the, post-election environment will decide a lot of stuff there, but I would say that at this point in time, the positive side is on, for example, data on, industrial production have sort of stabilized. Growth has stabilized at lower levels, 4.5%, 5%. It's not getting any worse. The data on current account has gotten better. Inflation data has surprised positively somewhat in the last 3-4 times when the data has come out. So you could say the green shoots are on the side of stress getting reduced, but not really on the side of growth, because growth numbers continue to be reasonably poor. Earnings stabilization to the extent has happened is largely because of exporters. You have seen exporters beating earnings, domestic cyclicals earnings continuing to be subdued. In this environment, capital goods probably will be a later sector to revive, and that there's a big if, because that if essentially emanates from the fact that as I said, post-election environment of policy will matter a lot. So at this point in time, I'm not a big favorite. It's not a big favorite of mine. I do understand that if people bet on Indian economy, they will probably buy these stocks as well, because there will be some hope, especially if you're betting elections, of growth revival, and these stocks are beaten down. But I suspect that between delivery and the stock price performance, there might be a gap which will open out. So these stocks can continue to do well for some time, but I think eventually the fundamentals will win out, and there I think there will be some challenges for capital goods stocks going forward.
Okay, in your long-only model portfolio, you have a preferred bias towards HPCL and BPCL. Do you think that's more like a tactical buy, or to your mind, oil marketing stocks have got permanently re-rated given the kind of diesel price hike we've seen in last 1.5 years?
So I mean that obviously there was an element of undervaluation. These stocks were trading very cheap at 0.4 times price to book, etc. So they were cheap. But I think there is a good reason to be more positive here structurally, because Nikunj, you would see that even despite the fact that elections are looming, the diesel price hikes have gone through. So the thing is that given the stresses on fiscal side, and given that you have committed to food subsidy, food security bill, etc., it will be very difficult to control expenditure and control fiscal deficit without reducing one or two of the subsidies. And really the easiest one and the most practical one has been oil. Interestingly, there has been no political noise about that pre-election. So frankly, nobody's come and said that diesel price hike is a bad thing for. So this has gone through smoothly. So I think there is looks to be political consensus, and if this continues, then at some point in time there will be profits to be made in the marketing side. These companies will be able to stand on their own without massive subsidy supports. So I think there is clearly because of fiscal constraints, there is reason to be bullish on oil sector, because this is the most actually the reforms in oil sector have the best, and there was a long time till these stocks actually sort of caught up to that idea. I think it's just started. It probably will go on for some more time.
Prabhat, data from China only seems to be weakening further. I mean, this morning as well, the factory activity has contracted only further in the month of March. So at a time like this, how would you approach the metals pack back home? Is it a best avoid? Because of late what we've been seeing seem to be more of trading moves than investment bets.
Yeah, so we are underweight metals. We went underweight in November when the stock price ran up sharply. One of the reasons is that, as you rightly said, there is, at this point in time, the Chinese data is quite weak. Secondly, the stock prices are not, screamingly undervalued. They were undervalued probably in August, September when they'd fallen off the cliff. But at this point in time, the stock price is not really undervalued. So I sort of don't see a big reason to be very positive. As I said, the recovery in the economy will probably be delayed. Secondly, the earnings per se, because metal prices are where they are. I mean, aluminum prices are low, copper prices have fallen, steel prices are not going anywhere. So there is no major reason to expect earnings surprises from where we stand today. So we would rather avoid, yes.
Okay, Arvind Mills, price volume breakout on your screen, 150 rupees for Arvind Mills. It's been realizations have gone up, domestic, back home. The branded retail market also has picked up, and in terms of volume and price action, it's there on your screen. Prabhat, the minute we think of a rupee correlation, we always tend to think about IT and pharma and IT. But do you think within the manufacturing space also there are a lot of export-dominated themes which could make money, be it an export-oriented name like Arvind's or an auto-ancillary exporter like Motherson Sumi? What I'm trying to gather from you is that is it time to really connect the rupee story with other sectors?
Well, I think they definitely will be. But the only thing one should remember is that if you've got very smart buyers on the other side, they will typically tend to take away the gains from margins. So so it could well be that you essentially, if you don't have that much of bargaining power, and you are more B2B player, then you could end up losing the rupee advantage, even though there might be a longer term volume advantage. So it depends on what kind of business you are in. I think in IT, for example, I think over the longer term, rupee gains might actually sort of go away somewhat, but not fully. But in pharma, it's quite possible that the gains will be fully retained because you are competing with, countries where the currency benefits are not as large. Similarly, I think if an auto ancillary company is, and it depends on the marketing, the power of the bargaining power that you hold. So then auto anc has much larger bargaining power with respect to the counterpart. They might be able to hold on to price gains. So I think the answer is not really straightforward, as I said, but definitely either there will be price benefits, that is margin benefit, or there will be volume benefits. Volume benefits typically play out over a longer period of time, therefore they tend to show up later. And it could well be the case why you are seeing some of the manufacturing companies doing well and some starting to do well with a lag.